Hi everyone, good morning. I can see there's some questions coming in and I will cover those just in my very brief introduction. So as I said, good morning everybody and welcome to this morning's session brought to you by the K3 Hub, all about commercial property tax issues. For those who haven't virtually met me before, my name is Marie Wadeson and I'm a Managing Director here at Quantuma, and on behalf of our parent company, the K3 Capital Group, I'm responsible for the K3 Hub, which is a member network for professional advisors developed by us and other companies within the K3 Capital Group. Since we launched in the spring of 2020, over 2,200 like-minded professionals across the country have joined the network, through which they've accessed a range of CPD and training sessions not dissimilar to today's event, and referral fees for certain types of work referred into our group. So moving on to today's main event then, I'm very pleased to be able to introduce you to our speaker today, Ros Martin, and I'm sure that many of you know her. Ros is a consultant, a lecturer and a former Inland Revenue Inspector. She covers all aspects of direct tax as well as SDLT. Today, Ros's session will cover ownership structures and non-resident landlords, capital expenditure and availability of capital allowances, premiums and lease incentives, CGT and SDLT issues, and VAT problems for commercial property. I've just got a couple of pieces of, well, more than a couple, actually. I've got a few pieces of housekeeping and information just before we get going. So we are going to run a poll this morning. There'll be 4 questions, and the team in the background will kind of poll those at the relevant points throughout the session. We'd love to obviously get your feedback. Q&A function is open, so do feel free to ask Ros questions. I just spoke to Ros before we signed in this morning. So what we've agreed is that Ros will try and answer them as should we go along. But if we do have a lot of questions coming in, and given the amount of people that we've got joining us today, it may be that we need to defer those until the break, so Ros can go through them, and she'll respond shortly after. On the basis that we have more questions than we're able to cover, we will share those with Ros after this session, and she will come back to us with answers, and we'll come back to you in the coming days. I get a lot of questions about this. So we are recording today's session, and the recording will be made available on the K3 Hub website, and that'll be sometime middle of next week. We are, as we've already been asked, we are going to put today's presentation into the chat box shortly, and I think we'll probably put a couple of versions in as we go along, just in case there's people who join later on. It will be the same document, but just in case there's people who join a bit later, we'll probably post that a couple of times. And finally, I think somebody's already asked about the breaks, because as you rightly point out, it is quite a long session. So we will have a couple of breaks this morning, 6-7 minutes, and we'll run those on the hour just to give you some downtime and take some comfort. And really, that's about it from me. So thank you very much to you all for joining, and over to you, Ros.
Thank you very much, and good morning, everybody. It's lovely to have so many people online this morning. Just to reiterate, please do feel free to ask questions, and I will do my best to get through them, or we will deal with them afterwards, as Marie has already explained. Okay, so I suppose that let's just start off by thinking about what on earth do we mean by commercial property. I think it's one of those things that most people will have a pretty good idea what they mean by commercial property. It has a specific definition for tax purposes. So actually what we find is that actually for capital gains tax purposes and for stamp tax purposes, we are looking at a definition of residential property, and everything else is then treated as commercial or non-residential. Now, we are going to touch on capital gains tax and stamp taxes, and when we look at those, when it becomes relevant, we will talk about what those specific definitions are. But of course, ultimately, we are always going to be dealing with clients that are going to have property that fall within that kind of general definition of commercial. So we could be talking about things like offices, factories, shops. But obviously, it also covers things like farms, and there are particular issues to do with, say, farming partnerships and land and those kind of commercial properties that do cause problems. Now, it's not particularly something that I'm going to talk about in any great detail this morning, but we will touch on those kind of issues. And so I suppose the question is why are we talking about commercial property in isolation to a general property update. And obviously, if we were talking about general property, if I was doing a property tax update, I would be covering some of the same issues. There is overlap between the different topics. But of course, there are also things which are very important for residential property landlords, such as interest restriction, which are irrelevant when we're talking about non-residential property. And then there are also things which we are going to cover today, which are very important when we're looking at commercial property, such as availability of capital allowances, because of course, for most dwelling houses, for most residential property, we're not talking about having any availability for capital allowances. Of course, the notable exception being furnished holiday lets. But capital allowances is a problem that is pretty unique to commercial property. We have leases, lease premiums, termination of leases, getting rid of onerous leases. All of those kind of things are the sort of things that we come across when we are talking about commercial property, which are completely irrelevant from the perspective of residential property. So yeah, there's definitely some overlap, but this is definitely not just a property tax update. We are really going to focus on some of those things that we need to think about in relation to commercial property. Okay, right. So let's start off by thinking about ownership structures. There is often huge dissent amongst the profession, amongst landlords, amongst property advisors, as to what is the best way to hold property. Now, often we are talking about companies versus individuals. Of course, with residential property, you don't have alternative options such as pension funds. Whereas with commercial property, there is the option of perhaps having your business premises held through a pension fund, for example. Now, it's an interesting one, and to a certain extent, we need to focus very much on why we are holding commercial property and what the structure is in relation to the actual holding of that property. So let's just divide commercial property holding into two clear sort of different sections. And again, I fully appreciate that it's never really this straightforward, or it may not be this straightforward. But are you holding this as an investment? Or are you holding this because it is part of your business? Now, there could be some overlap. You could decide that you are going to buy the premises that you trade from, but on the assumption that if that business is ever ceased, or if that business ever is ever sold, you will hang on to the premises because of the fact that you can then get an income stream from it, you know, potentially a rental stream in the future. So if you are talking about a property being an investment, rather than being part of your business, then it may well be that your thoughts about how you hold that property are going to be different. I suppose if it's part of your business and you are thinking that your business is going to be sold at some point, you always have to be alive to the fact that actually the person who buys your business may not want to buy the property, that property holding may not be part of their strategy, or they may not be able to afford to buy the property. So I had a piece of consultancy work sent to me at the beginning of this week, where we have got exactly that problem. We've got someone who's operating a trade through a company. The business premises are in that company. They want to retire. The current shareholders want to retire. They were very hopeful that they could sell the shares in the company, that they'd get BADR on that, and they'd waltz off into the sunset. But the purchaser's come along, wants to buy the business, but doesn't want to buy the property. And so you have immediately then got problems. Now, obviously, if you're looking at starting a business now, buying a property, whatever, and you're thinking of a 10 to 15 year exit plan, you have got no idea what the market is going to be like. you've no idea who might purchase your business, whether there's even going to be a market for your business. So it's very difficult when we're looking at these things, but some of those things become relevant. So if you are looking at something as an investment, then, you know, the thought that your pension fund might buy it is possibly quite a good idea, because, you know, the rent that is received within the pension fund will be tax-free for them. Any growth in value, if you did decide to sell it in the future, if you did find a purchaser who wanted to buy the premises as well, you know, that increase in value would also be tax-free, but you would get that value into the pension fund. Now, obviously, whether the pension fund can buy the property is another one, you know, is a difficult one, because sometimes pension funds simply don't have the funds to be able to purchase the property. So again, it's possibly a little bit hit and miss. In specie pension contributions, where you transfer a property into your pension fund as a pension contribution, is currently quite controversial and quite key, because ultimately there is a question as to whether or not you get tax relief on an in specie pension contribution, and the general direction of travel is that it's quite difficult to achieve a pension contribution, and you know, therefore it is difficult. We have just had a question about the recording of the webinar, and yes, I can confirm that a recording of this will be available on the K3 Hub, I think is the phrase that Maria used earlier on. Okay, so if you're holding property as an investment, you know, you have still got and you're not going to use something like a pension fund, you really have the same options as you would do if you had residential property. You have sole ownership or partnerships, you have companies. Obviously, it's less an issue than it would be for residential property, because you don't have the interest restriction. So one of the disincentives in holding property personally is going to be, if you're talking about residential properties, of course, that you get the interest restriction. Obviously, looking at things more generally, if you are holding property personally, you are going to be within MTD from 2023. If you meet the income threshold, then I think with commercial property, that would probably be the case. Part of a single property business held in the same capacity, if you've got more than one property, regardless of whether it's commercial or residential. So, for example, if you had a portfolio of property that was both commercial and residential, then you would potentially have quite a complicated interest restriction calculation. So because you've got to work out whether the borrowings relate to the commercial property, in which case you get full deduction, or whether they relate to the residential. And I've got a landed estate that I do the tax for, and that's the problem that we have with the chap that owns the estate, is that we have to do quite a complex calculation every year to look at the interest. So again, that is going to be problematic. If you're making losses, set them sideways off against income from the other property. Obviously, if you've got a company, again, it's going to be a case of crunching the numbers. As with anything that is going to be held within a company, you have got the issue of what the marginal tax rate is, and that is very much going to depend on whether or not you are extracting funds. Now, obviously, we've had the announcement by Liz Truss that the proposed increase in corporation tax rates is not going ahead next year, which means that effectively you do have perhaps a more benign tax position than you might have had in the future. Although I think that it would be naive in some ways to consider that you have that is going to be the case forever. Certainly, if we have a change of government at the next election, And, you know, whilst the polls very much point towards that at the moment, you know, a couple of years is a long time in politics, so who knows what might happen. But certainly we could have increases in the corporation tax rates in the future, which will need to be taken into consideration. With companies, losses can be used a little bit more flexibly in that corporate property losses can be set off against other income. So holding property as part of the business, so where you've got the trading premises, if it's a sole trade, then the property is automatically going to be part of the business. If it's a partnership, then you can either have property held outside the partnership by the individuals who run that partnership. It can be in the partnership as a general partnership asset, or it could be within the partnership with the capital value retained by one or more partners. Again, if you've got partnerships, they're not going to come into MTD until 2024 at the earliest. 2025 at the earliest. And so again, if you've got a company business, then you can have the property inside the company as a business asset, or it can be held outside it as a shareholder. And as we've already talked about, you can also have pension funds. Now, often, if we're talking about property holdings, then it may well be availability of business asset disposal relief becomes quite important. And we'll talk about that in a minute. So what motivates these decisions? You know, do you want to keep the trade and the property separate? Well, often you find that people do want to keep property and trade separate because they believe that there is an issue with liability. So if something happens in relation to your trading activities, which means that you end up having to pay out, then you perhaps want to ring-fence the value of the property. Now, obviously, some businesses just do not have worries about liability, and businesses like accountancy and tax advice may well mitigate those liabilities by having insurance. But I suppose it's about understanding your own business. I've recently done an expert witness report in relation to a professional indemnity claim, where the problem is that the PI insurance is not going to anywhere near cover the amount of tax at stake in this particular case. And so the individual concerned is very much looking at down the barrel of the gun at the moment. So if you have a corporate structure, you can actually separate property from the trade without there being automatic swap of liability. And obviously, the other point we've already talked about is the possibility of wanting to retain a business, the property following the sale of the business. Obviously, you need to be careful from an IHT perspective if you hold property outside of a partnership or a company, because you only get 50% inheritance tax. So, broadly, I suppose what we're talking about here is that there are just lots and lots of different reasons why people might hold property in different ways when we're talking about commercial property. And it really is not as black and white as it is for residential property. If you hold the property outside of the business, would you be okay to charge rent if you are holding the property personally and you've got a mortgage on it? You will probably want to think about charging rent. If it's a partnership and you're holding property outside of the partnership, you need to be a bit careful because the rent will form part of the profit share. So you would still get class 4 national insurance contributions on the rental income. If it's a company, you can pay rent to the owner. I was just slightly puzzled by that comment on the slide, which there's no NIC advantage. I think what I mean, there is an advantage because you will pay no NIC on extracting money from the company. Obviously, you need to be slightly careful about incurring costs on the property. One of the issues that I see quite often, or I do get asked questions about, is where you have got a property owned personally by director shareholder, where the company is incurring costs on the property. Now, if there is not a formal lease in place, you need to be careful, because HMRC may well argue that that is a benefit in kind on the individual. What you can do, however, is put in place a formal lease, which would then allow the company to make leasehold improvements. And then what you would normally do in that situation is have the company being compensated for any improvement work they've done if the property is sold, which would then allow the individual selling the property to claim those costs as an enhancement. Because the problem that you've got otherwise, excuse me, is that you could have the company having incurred the costs and not getting a deduction for them on the sale of the individual, not getting a deduction for them on the sale of the property. And in fact, we've recently had a tax case on that point. So again, yeah, I'm sorry, somebody's asked me to clarify the point about NIC on rents. On a partnership business, if you are a partner who owns the property personally outside of a partnership business, basically any rent that is paid to that individual partner is treated as part of the profit share. So the partnership does not get a deduction for it, and the individual is not taxed on it separately. It is effectively taxed as part of their profit share. It's the same answer unless there are different rates of tax paid by different partners. But what that means is, because it is part of the partnership profit share, then there will be class 4 national insurance contributions on it. It'd be a lot easier for me if you could put the questions into the Q&A box rather than the chat box. That's just procedural from my perspective, but don't worry. Question, are the furnished holiday let property rules relevant for properties held within companies? The answer is yes. A company can hold a furnished holiday let property itself. How would these apply to a house used for events, weddings and corporate events? How would that fit into this? It's more like a tiny hotel. Well, again, I mean, the use of a property, I mean, if you have a house that is used for weddings and corporate events, I suppose the big question would come up, is the owner of that property actually living in that property? And if they are living in the property, there are considerable complications if it is within a company. Because if the property is worth more than £500,000 and the individuals are living in the property, then there can be ATED issues, annual tax on enveloped dwellings. But so often, if you've got, I mean, if you have a property that is used for sort of weddings and corporate events where the owners are not living in there, or indeed perhaps if they're living in a flat, actually they couldn't get the accommodation benefit exemption. I'm just thinking they wouldn't get that if they were director of the company. I think it is more likely that it would be cost effective to have that outside of the company, though of course you could have a situation where the actual business was undertaken by the company and the property was outside. So yeah, again, we can have a look at that. Laura, you've asked me for the case reference for that company compensation and enhancement case. I will have a look and see if I can find it at the break. I know roughly when it was heard, but it's just whether I can find it, but I will try and do that. So hopefully I will be able to come back on that one. So leave that one with me. It was a bit of a complicated case, to be honest with you, but it was that general principle was relevant. Just touching on non-resident landlords, of course, non-resident landlords are subject to tax in the UK on income arising from UK land and property, because the source of the income is still within the UK. So rent should be paid under deduction of tax. You can sign up to the non-resident landlord scheme, in which case the rents can be paid gross, but that is predicated on the fact that the individual is going to make a tax return. And most people want to sign up under the non-resident landlord scheme. You do also need to consider the interaction with the double tax treaty with the country of residence. Typically, the country of residence will also tax property income as well. So if it was the other way round, if you had a UK resident individual who, say, had property in France, that would be taxed both in the UK and in France as well. But if we're talking about UK property, it is likely that the UK will have what is called primary taxing rights, which means that it's taxed in the UK, and you have the foreign country, the country where the person is resident, would have the possibility of giving double tax relief, but the tax would still be due in the UK. Now, a little bit of a wrinkle with non-resident companies that own property, just as a reminder. Prior to the 6th of April 2020, overseas properties that had UK property, residential or commercial, would have been subject to income tax. But from the 6th of April 2020, they came into corporation tax. Any losses that were being carried forward can be set off against profits for corporation tax purposes, and those are not subject to the cap on losses. No capital allowances adjustment, so you basically just apportion it between income tax. No quarterly instalment payments in year one, and then any interest now falls into the non-trading loan relationship rules. So fairly straightforward, and I think most companies caught by that will now sort of have that under their belt. Okay, somebody's asked a question about ATED. If the property is owned jointly by the individual and the company, and the individual lives there, presumably ATED doesn't apply unless the company share is worth more than £500,000 and the individual share doesn't cover the proportion used as his residence. Well, actually, that's an incredibly interesting question, because when you are looking at the value of a property held by a company, and as to whether or not it breaches the 500,000 threshold, you have to take account of property held by connected parties. So you cannot get round the ATED provisions by having a property worth £600,000 held 50% by the company, 50% by the shareholder, on the argument that 300,000 is below 500, so ATED doesn't apply. So actually that idea of having the property split between two individuals. Now, if you did have a property where there was, say, a self-contained flat, I suppose what you could do would be to have the property held in the company and perhaps have a lease to the shareholders on the flat. But again, I'm just thinking that off the top of my head, and even as I'm saying it, I can think of reasons why that might not work. So no, it doesn't work, Keith, to have the property jointly owned in that way if the total value of the property is over £500,000. For non-resident companies, can pre-2020 income tax losses be set off against later gains? I hate it when this happens. I'm not sure that I actually know the answer to that question, because and let me just think about this logically, because carried forward income tax losses would not be available to be offset in the against future capital gains, would it? So I don't think that, I've got a feeling that you can't, because I think that the income tax losses can only be carried forward and set off against the profits arising from the property stream. Yeah, now I'm thinking about it more. I think that that is correct. Again, if I get a chance, I will check that at one of the breaks, but I suspect I might not have a chance. Okay. I'm not sure I know what the question is for the next one that's been submitted. So can I just ask you to clarify? I think maybe you may be asking about ATED, but can I perhaps ask you to clarify that question? And someone's just said that they missed the first half hour, and is there a copy of the slides? We will load a copy of the slides again during the course of the webinar, just for people like yourself who joined late. Oh, there they are again. Thank you very much to the administrators for doing that. So hopefully you've got a copy of that now. Okay, so we have got, we're now going to move on to talk about capital expenditure. And rather frighteningly, I'm already behind with my timings, but there we go. Actually, before we do that, I think we'll have the first poll question. So perhaps I could ask the administrators to just pop the first poll question up. Hopefully it's very straightforward. Can I just stress that all of the answers are anonymised. This is not meant to be a difficult question. It's just meant to be a very quick question to ask you if you want to have a go at that. Now, I can't actually see how many people have answered, but I think that the administrators are going to close the poll just when we have had enough people voting on that. So they will do that at some point. Hopefully, by the time we get to the end of this section, you would be able to answer this question very well. Okay, perhaps we can bring that poll to an end then. Oh, okay. Oh, well done. So, more information needed. Yes, I think that is the case. So we've got a client who buys a property to rent out, but he renovates it. It is not an easy question to answer. And in reality, we would probably need more income. So what is capital? You can get a deduction for revenue expenditure. You can't get a deduction for capital expenditure. And that would apply, the same principles apply whether you are holding that property as an investment or whether you are holding it as part of your business trade. So we know that it doesn't include anything that's revenue. And to be honest with you, our view of that particular point is largely determined by case law. So the case that's always quoted is a case called Atherton v British Insulated and Helsby Cables, which is the case that's always quoted, but in my view is not particularly relevant. It talks about an advantage for the enduring benefit of the trade. But in the context of something like repairs and renewals, I'm not sure that that is really very helpful. The key that we have is basically, well, let's just think about the chronology. There's two things we've got to think about. Is the expenditure capital? If it is capital, will we get capital allowances? And we're going to talk about capital allowances in a moment. Now, obviously, if you have got expenditure, which is capital in nature, then if you don't get capital allowances on it, then you are not going to get any relief on that expenditure until the property is sold. And that could be a long time down the line. So there is going to be a real imperative to try and get relief as quickly as possible. And of course, now that we've had a permanent increase in the annual investment allowance to £1 million, you know, capital expenditure that qualifies for capital allowances can often be relieved. There are often issues because there will be insufficient evidence produced or given to you by your clients for you to make an informed decision. And so where there's significant sums involved, it's quite important to try and be engaged from the beginning of a project. Law Shipping and Odeon Cinemas has just been talked about in the Q&A. I'm going to talk about those in a minute. So you have preempted me, so thank you for that. Okay, so initially the thoughts that we have, there are two things that make expenditure capital. You're replacing an entirety. Now, it is unlikely that if we're talking about something like commercial property, that you will have replacement of an entirety unless you are talking about something like a complex where there are separate buildings. But it's important to acknowledge that the entirety is the whole building. So, and I'm sure people are aware of these principles, but you know, it's always quite useful to go through them. If you've got a factory, and it could be a huge factory, and you replace the roof on that factory, you could be talking about lots of expenditure, significant amount of cost, but that can be a repair because the building is the entirety, the roof is only part of that whole building. But what we'd then be focusing on is whether there is an improvement, because the other thing that makes expenditure capital is where there is improvement. Something about the roof, something about what you are doing to the property makes the property different. Even though the terminology that we always use is improvement, I think it is important to remember that improvement is possibly not the right word to use in this context because it's different. Because if you redecorated a building, you might improve it, but that is not going to be capital expenditure. So, and in fact, if you had a building that had a wall down the middle of it and you knocked down the wall, that would also be capital, but you might argue that's not an improvement. So it's just different than it was before. As I've said, replacement of the entirety is often very straightforward. Second is much, much more problematic. I think one of the big issues that we have, and this is often the case with commercial property, is that it may well be a long time between work being done, because often with commercial property, things can get quite bad before people get round to doing anything. And that's often because there will be a disruption to the business while work is being done. Or it may well be that it's rented out on a repairing basis, and then the tenant doesn't repair it, and so the landlord is then having to do so when the tenant leaves. And we're going to talk about that a little bit later on. The real issue that we have when we're looking at improvements is, what about a situation where you can't actually replace it like for like because the materials used are not going to be the same. You can't actually get the same quality. Anything that you do is inevitably going to be better quality. The revenue do accept that that argument is valid, but they may ask you to prove that. And so that is something that we do see. Now, we move on to the sort of question that we asked at the beginning. And that is, what about if you have a newly acquired asset? And this is where you have a question about whether or not you can have expenditure. And as Keith pointed out to me in his question, there are two very familiar cases Odeon Cinema law shipping. Odeon is the only one that involved property, but they are key cases. So in the law shipping case, just to remind you, company buys a ship, not really seaworthy. It should have gone into dry dock to be repaired, but they got dispensation from the Secretary of State to do one final voyage, and then they did repair work. Odeon Cinemas, Odeon was buying property during the Second World War, and it took a long time before they repaired that property because of a lack of availability of building materials. And so the 2 points that were established in this particular case, could the asset have been used without the work being done, and was the purchase price suppressed due to the condition of the asset? In law shipping, theoretically, the ship should not have been used without the work being done. As I say, they did get dispensation, but that was not really what should have happened. And there was quite a lot of evidence to demonstrate that they had got the ship quite cheap because of the fact that that it needed the work doing on it. In the Odeon Cinemas case, the property price was not suppressed, and the assets were demonstrably used for a number of years before they were repaired. Now, I always think, going slightly off topic, but I always think that the Odeon Cinemas case is quite an interesting one, really, because the reason that they were not the price was not suppressed was because buildings were in short supply after the war, and the reason that people were willing to go and sit in a fairly dilapidated property and watch movies was because it was the war, and it was the immediate post-war. So, but that doesn't detract from the fact that that was the decision that was actually made. So, you know, again, we have got those kind of principles. So if we go back to the poll question, client buys a property to rent out but before doing so, he renovates it. He argues that it is just normal repair type expenditure. So what you would be looking at is that, you know, would it have been possible to have rented out that property in the state that it was? Did he get that property cheap because of the nature of the work that needed doing? And I suppose focusing on exactly what it is that he's doing, because it may well be that, you know, it's expenditure which is just normal wear and tear. But again, you would need to have a look at that in a little bit more detail. As I say, what you really, the ideal situation is in any case, is that you get involved before the work is done. Or if you don't want to get involved, then, you know, make sure that the client takes lots of photos of what the property looked like before and what it looks like afterwards, so that you can use those in the event of any questions being asked. Okay, so we then move on to talk about capital allowances. Now, the legislation, the capital allowances legislation, specifically states that you cannot get capital allowances on buildings. But then there are exceptions in relation to assets within buildings. So we're going to talk in a moment about the integral features regime. Now, you can very, very occasionally get capital allowances on the building itself, where it has a function beyond just being a building. So we currently have a case going through the courts on a nuclear fuel reprocessing plant. Now, I appreciate that I suspect, I don't know, obviously I suspect that there will be nobody on this call who actually has any clients doing this kind of thing. The cost of this plant is around £1 billion. And they claimed capital allowances on the whole structure. And HMRC denied capital allowances on £192 million worth of expenditure on the basis that it related to the building. Now, it got to the upper tribunal, and the upper tribunal has actually referred it back to the first tier tribunal on the basis that they had not considered whether the building itself had a function. Now, I know nothing about nuclear fuel reprocessing. But I imagine that the building needs to be a specialist type building, presumably made of particular material and quite thick walls. It's not going to be a Nissan hut, is it? So it may well be that it has a function beyond just that of being a building. The case I always remember on whether or not a building has any function was a case involving a swimming pool. And I always remember this because the courts described the function of the swimming pool as providing pleasurable buoyancy. And as I swim up and down my laps in my local swimming pool, I often think about that, even though it's often not pleasurable and I'm often not very buoyant. But there we go. So you have to be arguing that the building fulfills a function. Sometimes there have been successes with the revenue. There was a case a few years ago involving a silo where the actual building that the silo was in was found to be a building. But you can get capital allowances on fixtures and fittings within buildings, and that is what we will consider. So there is kind of cross fertilization really between terminology when we start to talk about this. The legislation talks about integral features, other bits of the legislation, sorry, integral features, other bits of the legislation talk about fixtures. We're kind of talking about the same thing. Actually, someone's just put in a comment case a couple of years back on potato storage building for crisps. Of course there was, yes. Taxpayer won that case because the whole building was there to maintain the temperature and the condition of the potatoes. That was fairly similar to the silage case. So yes, actually with farming, we do get, we have had a couple of successes on those points. If we talk about integral features, this is legislation that was introduced in 2008. It is called the expenditure on integral features goes into the special rate pool, which means that you do get a low rate of writing down allowance than the main pool, but you do still qualify for annual investment allowance. And as I've said, again, that can be beneficial, will be beneficial now we've had an increase. So, as I say, provisions introduced in 2008, expenditure incurred from them then afterwards. And this is why this legislation is quite complicated when we are looking at acquiring property. It's about knowing when expenditure has actually been incurred. Now, the other point to talk about, which is quite important, although less important if you have got 100%, well, you've got annual investment allowance to utilise. Normally, repairs to assets which form part of the integral features of a building would be repairs. So we will see in a minute that, the definition of integral features includes, heating systems. If you say repaired the heating system in a building, that is not replacement of an entirety, and therefore that could be a repair. But there is an anti-avoidance provision which says that if the cost of the repair is more than 50% of the asset value, then it is capital rather than revenue, and it does become a capital allowances item, though, as I say, that may not be too much of an issue. So just to be aware of that fact, though I don't see many inquiries on that particular point. So what is integral plant? Electrical systems, including lighting systems. So that basic lighting, I mean, it used to be, and this was on the back of a tax case involving John Lewis's at Brent Cross, if you had specialised lighting in places like shops, you could get normal capital allowances on them. But now you can get capital allowances on basic lighting as well. Now, again, if you don't have annual investment allowances, then you may want to try and get this in as specialised lighting, so that you get normal capital allowances rather than integral special rate pool capital allowances. But you know, anyone who's got annual investment allowance, it's not going to particularly matter. Cold water systems, space and water heating systems, aircon and ventilation systems, and any part of your building that actually forms part of that. So if you have central heating or air conditioning ducts in the ceiling, and the ceiling actually forms one part of the duct, then you will get it for the cost of the ceiling as well. Lifts, escalators and moving walkways, and external solar shading and active facades, so things like solar panels. So yes, all of those things can qualify as an integral part. And as I've just said, there may still be a distinction between special rate pool integral features and normal capital allowances. So again, that is something that we need to look at. So with each type of commercial building, there are different assets which may attract capital allowances. And with different types of commercial buildings, it may well be that you can identify different types of assets. Now, I am not going to go through any of these now, because to be honest with you, I would just be sitting here reading through lists and lists of assets that might qualify. But there are decent reference books on capital allowances which tend to contain lists of assets. Bloomsbury published quite a good annual on capital allowances, and that has got quite a good section on the kind of capital allowances that you can get on different buildings. Claritax have a book called The A to Z of Capital Allowances, which kind of goes through, doesn't format it in quite the same way, but goes through every single asset that you could probably think of and whether or not you can get capital allowances on it. And HMRC's guidance manuals are actually quite good as well. So, you know, as I say, I think that there is certainly plenty of background information, and it may well be that you know, the K3 Hub also has access to that kind of information as well. So it is worth looking at that. Okay, so I've been asked the question, can you claim capital allowances on assets forming part of the commercial property, even if they're not separately valued as part of the sale? And that is the $6 million question. They're obviously not necessarily quite as much money. This is where we start to get the complications, and this is what we need to think about. So again, this is where the terminology starts to slip slightly. A fixture is any item which is installed in or fixed in a building which has become by property law part of that building. So if we go back to the basic property law, what we're saying is that if you buy a property and it has things like lighting, heating, air conditioning, all of those kind of things, those have become part of the building from a landlord perspective. And so you own those by virtue of owning the building. Now, when we're talking about fixtures in this context, it will definitely include all of those things that are integral plant, but it might also include other things. So, you know, whether or not they are things which qualify for general capital allowances, so things like, you know, fire alarm systems, you know, sort of sprinkler systems, other things which, so the general terminology of fixtures is going to cover things which are integral features, but also assets on which normal capital allowances have been claimed, but also there may well be other things in there as well. And as we will see in a moment, may also, if you are buying a building, include things which capital allowances have not been claimed. So, as I've said, we're largely focusing on integral plant. Now, the first thing is that there is a particular provision that we need to think about where somebody leases, has a leasehold interest in that property. Now, because if you have leased a building and you incur expenditure on that property, that the benefit of that effectively is to the benefit of the person who holds the freehold. There could be a situation where you have a leaseholder incurring leasehold improvements, but where they won't get the capital allowances. So there is a specific provision which says that broadly, whoever incurs the expenditure can get the capital allowances as long as they have got a proper interest in the land, either a freehold or a leasehold interest. So if we go back to the bit I was talking about at the beginning, where we've got perhaps somebody who's a director shareholder of a company holding a property outside of a company, and the company incurs leasehold improvements, which might qualify for capital allowances, they would not be able to claim the capital allowances if they did not have a formal leasehold interest. So again, you just need to be slightly careful about that. If there is a joint contribution, so for example, if you've got more than one tenant in the same building and they jointly contribute to having assets, incurring expenditure, on which capital allowances would be due, then they would both be able to claim a relevant proportion of the costs incurred. So it is just something which I think people often overlook. Broadly, you are probably going to be able to get leasehold improvements, but as capital allowances, but it is not always straightforward. Okay, well, I make it 1 minute to 10, so we are almost up to the end of the first hour. And to be honest with you, that is quite a convenient place to stop. So what I will say is we'll stop now, and we will come back just about 10:05. So do pop any questions into the chat box if you wish to do so. Let's get started again. If a subsidiary company incurs the costs relating to a property ineligible for capital allowances, can they create a recharge to the parent company for the ineligible capital amounts, so the parent company will get the relief when they dispose of the property? Yes, I can't see why there would be a problem with that. I think that does work. Somebody's picked up the question about whether the fixtures legislation does allow for claims if there is a license to occupy. Yes, I think I would have to check, but I do think that a license possibly would be a relevant interest in land, but I would have to check the legislation on that point. I think that the point that I was making is that if there's absolutely no arrangement, it would probably be very unlikely that HMRC would consider that a relevant interest exists. The questioner then goes on to say, if the company is occupying a property, would you be able to argue that a license exists? My experience is that in the absence of a piece of paper, HMRC will be probably very reluctant. I've had cases in the past where we've struggled. I think they would be very reluctant to actually, basically allow that. So I have cases in the past. And then it mentions that with structures and buildings allowance, you do need a formal lease, and I think that's my understanding as well. Okay, just before I get started again, I haven't managed to find this case reference yet. I did spend the whole of the 5 minutes trying to find it, but I can't find it yet. So hopefully I'll manage to do that in the next break. Okay. So this is where it kind of gets a bit complicated. This is legislation that was introduced in 2012 to stop what the Revenue perceived to be abuse of the capital allowances provisions on fixtures. So prior to 2012, there was quite a lot of retrospective claiming of capital allowances in relation to fixtures on buildings, because the question, or the sort of the way it went was that somebody bought a property, part of what they paid for it should be allocated to fixtures but isn't, and then basically somebody comes along retrospectively and says, okay, we can do an assessment, we can work out what was in that property when you bought it, and then you can make a retrospective claim for capital allowances. Now, you can't always get annual investment allowance, but you can start claiming writing down allowance. So for post-2012 expenditure, it may well be, and it's may well be is the key thing here, that the availability of capital allowances to the purchaser is going to depend on meeting two things: the pooling requirement and the fixed value requirement. The fixed value requirement can potentially be replaced by what is called the disposal value statement requirement, but that's something else we need to have a look at. If you do not meet those requirements, then the bottom line is that the purchaser cannot get capital allowances on the expenditure that they have incurred on fixtures in the building. Now, I am going to go through the tests, but it is important to remember, and I will talk about this afterwards, that there are circumstances where you do not have to meet these requirements. And that is where the vendor of the building could not themselves claim capital allowances in certain circumstances. So we'll come back to that in a minute, but let's have a look at the basic rules first. The first is the pooling requirement. So where the past owner was entitled to claim capital allowances, they have to bring the historical expenditure on the fixtures into a pool of capital allowances expenditure for a chargeable period beginning on or before the date of the sale, or there's been first year allowance, so there is no residue of expenditure to allocate to a pool. So what we're saying is that the vendor has to have identified the expenditure on which capital allowances is due and put that into a pool of expenditure. Now, they do not have to have claimed capital allowances. So in the accounting period in which the property is sold, they could effectively just bring the capital expenditure in and then take it back out again as a disposal, but they have to have actually pooled the expenditure. Now, if the previous owner could not have claimed capital allowances, for example, because it was integral features, its expenditure on integral features before April 2008, then this condition cannot be met and the legislation does not apply. And we'll come back to what happens in that situation in a minute. Now, in terms, so actually, let's just have a look at an example. A Limited buys a property in 2009 and is now selling it. B Limited can only claim capital allowances on the fixtures within the property if A Limited has added them to its pool of qualifying expenditure. So A Limited would probably be wanting to maximise the amount of value for fixtures in the property to enable B Limited to claim the highest amount of capital allowances. Now, as the property was bought after 2008, there should be no restriction for old expenditure. So theoretically, what could happen in this situation is that A could look at the purchase price that it had paid in 2009, and it could allocate part of that purchase price to the fixtures. And basically add that to their pool of expenditure. Now, doing something that retrospectively would run the risk that the revenue would challenge that figure. So if they did that, it doesn't mean to say that HMRC couldn't challenge that figure. If A Limited had incurred any expenditure on capital allowances, on fixtures, which it had not added to its capital allowances pool, it could do that now. And if the sale was going to take place in the 1st of October, on 1st of October 2022, and A Limited had a 31st of March year end, then the last period in which they could make additions would be the year ended the 31st of March 2023. So in the run up to the disposal, they could get that expenditure pooled, which would then enable B Limited to be able to claim those capital allowances. We then move on to the second requirement, which is the fixed value requirement. And this is where you have got expenditure that has been placed into a pool by the previous owner, and they are then required to bring in a disposal value. Basically, that value that is going to be attributed to the capital allowances has to be determined in one of two ways. They either have to sign a joint election under section 198 or 199, and that has to be done within 2 years of the date of disposal. Section 198 is the bit of legislation that relates to freehold properties. Section 199 relates to leasehold properties. Or if you cannot agree a figure between the parties, then either party can make an application to the first tier tribunal to determine the figure. And normally that would be done by way of a section 198 or 199 election. I am not aware of any case that has yet, so it's 10 years since this legislation's been in place. I'm not aware of any case which has yet been referred to the first tier tribunal to make this determination. It's not the sort of thing that's likely to get a great publicity, so I may not be aware of that. Okay, so perhaps I could ask if the second poll could be put up at this stage. Apologies, I didn't give you any warning for that, but perhaps we could get the second poll put up. So what we're asking is what is the maximum amount of value that can be allocated to an asset under a section 198 election? The market value of the fixtures, the price paid by the purchaser, or the original cost. So we want to know the maximum amount that can be allocated. Whilst you're doing that, the lady who asked me for the case reference for the company compensation case, only I can see the Q&As that are the questions that are coming in. So do you want to just pop your email address into the Q&A box? I don't think I'm going to be able to find it, particularly when I'm going to need a cup of coffee at the next break. So I will find the case reference and email it over to you. If you want to do that, I'd be more than happy to do that. Okay, I think we could probably close the poll there. Okay, so the maximum value, we've got a fairly even split, but slightly higher for the original cost. And that is actually right. The maximum amount that you can actually put on a Section 198 election, so the maximum amount of value, is going to be the cost that was paid by the original purchaser. So the person who's now selling the asset, then the maximum amount, it will be what they paid for it. Because the maximum amount that would ever go into their disposal proceeds from a capital allowances perspective is going to be the cost to themselves. And what we're effectively doing is mirroring the purchase price for the purchaser with the disposal proceeds for the vendor. So the maximum amount they're ever going to be able to put in is going to be the original purchase price. So thank you for participating in that. So continuing the previous example that we looked at, let's just say that A Limited has installed a heating system whilst they have owned the property at a cost of £30,000. Now, the maximum, and they have to, and the two parties, A and B Limited, have to apportion an amount by signing a Section 198 election. The value that you put on the Section 198 election can in fact be anywhere between 0 and 30,000. It cannot exceed the cost, but it can be any figure that is less than that. And in reality, the amount that will go on your Section 198 election or 199 is going to be entirely down to negotiation between the parties. So it is just going to be, depends on, how much each party goes in with negotiation. Now, the other alternative I talked about in relation to a fixed value requirement, if we go back up to the slide talking about fixed value, that can only apply where a past owner has been required to bring in a disposal value. But the problem that we've got is that that past owner does not have to be the immediate past owner. So we get complications where we have situations where the person who is selling the asset has no requirement to bring in a disposal value. And that would be, for example, where someone, perhaps it's something like a charity, where they're not claiming capital allowances on the property. And so they are not required to bring in a disposal value. Now, as I say, the past owner bit doesn't have to be the immediate past owner. But what you can do instead is that you can submit a statement showing what the disposal value was from the last person who claimed capital allowances. So, for example, if you had, say, a charity that was buying a property off a vendor who had claimed capital allowances, what you, as the charity, would want to do is get a disposal value, or a disposal value statement from that vendor, so that if you then sell the property on, you can effectively pass on the entitlement to capital allowances to the purchaser. Because if you don't get that, then when you sell the property, you are not going to be able to pass on any capital allowances to the purchaser. So it becomes problematic. So if you are if you are selling to an organisation that is, so it works the other way around as well, you would want to potentially provide a disposal value statement. To be honest with you, that bit of the legislation really does not work very well at all. So that's the kind of basic way that it works. So let's now think about a situation where the previous owner did not have an entitlement to capital allowances. Now, again, there are different ways of looking at this, because you might have a person who was not entitled to capital allowances because they were a charity or something like that. Or it might be that the previous owner didn't have entitlement to capital allowances because, as I said earlier on, it was, say, pre 2008 expenditure on fixtures, and therefore they didn't have an entitlement to capital allowances. And so to that extent, you've got a problem. And in that case, you can simply apportion the purchase price on a just and reasonable basis to give you an amount on which capital allowances can be claimed. I think what is really problematic here is getting the information. And I'll come back to that point in a minute, because it really is problematic. But let's have a look at some examples. So Simon buys an office building in 2012, which he is now selling. Sorry, 2002. He was not able to claim capital allowances on his expenditure as it was before 2008. If there was any post-2008 expenditure, then the normal pooling requirement and fixed asset requirement would be able to be used. But for the assets that were already intrinsic in our building, then the purchaser would be able to claim allowances on that basis on a just and reasonable apportionment basis. Now, obviously, as I said, the problem might be is determining what within the building was acquired when Simon acquired the property, might have been put in the building between 2002 and 2008, or might have been put in after 2008, on which the Simon could have claimed capital allowances. So it's sifting through all of that information. Looking at another example, we've got a pension fund that has owned a block of offices between 2011, which it is now selling. It is the only past owner since 2012. So when we say you've got to go back and get this information potentially from a past owner, it is only where that past owner has had the property post 2012, which would mean that because the charity couldn't claim capital allowances, the pooling and the fixed value requirements don't need to be met, which means that, again, the buyer can claim the capital allowances on an apportionment basis. What if the pension fund had acquired the property in 2015 from James? In that case, the position would be different. The purchaser would need to identify expenditure which might have been incurred before 2008 on which capital allowances might have been claimed. The chances of you being able to identify that, I would imagine, are quite slight. For any expenditure that James has incurred post 2008, then you'd only be able to claim capital allowances if the pension fund's got a disposal value statement from James. So again, by 2015, these provisions were still very vague in many people's minds. So I'm not sure necessarily that it is going to be straightforward to get that. And then the final example, care home is selling a property which it acquired 6 years ago. They claim capital allowances on some of the flats, on the costs, but not all of them. They agree a disposal value on the listed fixtures in the amount of £40,000. 3 years later, the new owner realises that a claim could have been made for the remaining fixtures in the property, but he would have had to have got them Care Home Limited to pull those before the sale. But after 3 years, it's too late and the value is permanently lost. So it's really, really not that straightforward. So if you are acting for a someone who is buying a property, what would you need? What information would you want to ascertain? Well, is the property in question held by the seller as a fixed asset or as trading stock? If you're buying off a developer, you are the first purchaser of that property, and therefore the previous owner would not have had an entitlement to claim capital allowances. So you would be able to claim on an apportionment basis. Was the seller entitled to claim capital allowances, and if so, have they pooled the expenditure? What capital allowances have been claimed by the seller in relation to fixtures, and you would need to know the quantum of the claim and the precise assets on which claims have been made. Do you know what? I have no idea what that means. Has the current seller owned the property from the 24th of July, 1996? Do you know, my mind's gone completely blank as to why that is relevant. I have to think about that. I'm really sorry. My mind has just gone completely blank. Will the seller give a legal commitment to sign an election under Section 198? If so, requested by the purchaser. And then the legal agreement should also commit to including a particular figure in the, IBAs, someone said. I don't think it is IBAs. Do you know, I've gone completely blank. I'm going to have to check that at half time. What other capital allowances claims have been made either by the current seller or the previous owner? So in reality, you just need to get that additional information to be able to work out whether or not you are going to have a valid claim in relation to the capital allowances. So it is not a straightforward one. Right, let me just have a look at this question. If the vendor bought the property in, say, 2000 with various integral features, including a heating system, then in 2015 they replaced the entire heating system at a cost of £50,000. Can the Section 198 election cover the £50,000 and an apportionment of the original cost? No, because the you have to. So basically, you're saying is can you basically get the original cost basically no. So you don't because you can only get an apportioned cost if you can demonstrate that the asset is still present in the property at the date it was sold. So basically the value that you bought in 2000, it no longer exists in the property, and therefore you cannot get the situation. Thank you very much, Joanne. Of course, that's right. When we're talking about, when we're talking about the disposal value on fixtures, the legislation talks about the event by reason of which the disposal value has been or brought into account is an event occurring on or after the 24th of July 1996. That's when the fixtures provisions were introduced. Thank you so much for that. That was something that I'd completely forgotten. Yeah, the Finance Act 1997 changes. I do apologise. That was just something I completely, as I say, got completely blank on that one. It does happen occasionally. Okay, so I think that's the problem that we have really when we've got purchases. Thank you for everybody who made comments about that in the chat as well. That is very useful. Okay, so I think it is the information that you need to get that is problematic in these situations. When you kind of work your way through the legislation, is to an extent fairly logical, but ultimately it's getting that information that's going to be problematic. Right, structures and buildings allowance. So this is something that was introduced a few years ago. When it was first introduced, it was at a flat rate of 2%. It went up to 3%, and there is a higher rate for Freeport tax sites at 10%. And the growth plan that we had 10 days ago, or 2 weeks ago, actually, now, isn't it, has announced a 20% higher rate for enterprise zones. God, I couldn't again remember. Gosh, I'm not doing very well this morning, am I? So effectively, new commercial buildings or structures, although you can get conversion and renovation costs as well, limited to the costs of the actual building itself, not the land. You make the claim, sorry, it is applicable for contracts that were entered into on or after the 29th of October 2018. So that was the date of the budget in 2018. And basically, you make the claim when the building first comes into use, and then the allowances automatically pass over to the new owner. The only thing is with that, again, the point is that it is subject to evidence of entitlement. So if you are buying a building post 2018, then you will need to get a certificate of entitlement from the previous owner that they have been claiming SBAs. You're not able to get relief for things like the costs of getting planning permission, no balancing adjustment when you make a sale. All that happens is that the residue of expenditure is just passed on to the purchaser. Expenditure on integral features continues to be eligible for AIA or writing down allowance. And indeed, if there was any specialist plant and machinery, you would also be able to claim AIA on that. And then SBAs do not qualify for annual exemption, annual investment allowance in their own right. So looking at some fairly straightforward examples, company incurs £2 million worth of expenditure. It's actually a mixed use development comprising retail outlets on the ground floor and student accommodation above that. When I was writing this example, I did think that actually it's not a particularly good example because student accommodation can sometimes be treated as non-residential, but we'll come back to that point in a moment. The retail space would qualify for SBA, but the student accommodation does not. It's specifically, it's treated as dwellings for the purpose of this. And it is decided that 1/6 of the cost relates to the retail space. So the cost of that is going to be 333,333, and at 3% a year, you would get £10,000. Now that is a situation where that £2 million definitely does not include the land, because this is someone who is constructing this asset. Now, obviously, if you were buying a property for £2 million, you would also have to exclude the value of the land. Now, when we're normally talking about capital allowances, so integral features, normal capital allowances, it doesn't matter when in the accounting period you acquire the asset on which you are making the claim. There is no pro-ratering of the costs. So, if I spend £10,000 on a new central heating system, then it doesn't matter if I incur that in the week running up to my accounting date, I still get full capital allowances. But that is not true of structures and buildings allowance. So here we have a company that has a 31st of December year end. The building is constructed from £1 million and it's brought into qualifying use on the 1st of April. Basically, in the first year, they are going to be able to claim 3% of 1 million, but only 9/12 of that. And then in each subsequent year, they can claim the full 3%. Obviously, when we get to 33 years down the line, they would only get 3/12 in their final accounting period. But again, that's all that matters. If the building was sold to someone else, they would again just continue to claim £30,000 per annum until the expenditure is exhausted. No balancing adjustment for the original purchaser or anything else. A builder buys land for £300,000 and constructs a warehouse at a cost of £600,000, and then he sells that to a trading entity for £1.2 million, and that trading entity is going to use it for storage. So it is going to use it for commercial purposes. Now, in this particular case, the qualifying SBA expenditure for that purchaser will be an apportioned amount of the £1.2 million. So, you know, if we're talking about the fact that the land is worth about 1/3 of the value of the property, then, you know, arguably you've got £800,000 worth of expenditure. But, you know, the apportionment is done on a just and reasonable basis. If the trader were actually to sell this property before occupying it, and they actually sold it for £1.25 million, there's a little bit of a wrinkle in the legislation, because again, assuming that they're going to use it for the purpose of the trade, the claim would be made on a proportion of the first purchase price, so on an apportionment of the 1.2 million more than the 1.25. So again, it's just to be aware of those wrinkles. So with SBAs, the complication sometimes comes when you have someone who owns a property and then grants a lease in that property. Now, when you sell a property, you are transferring the relevant interest. You are transferring your freehold interest. So you are no longer going to be able to claim any allowances. That's fairly straightforward. But of course, if you grant a leasehold interest, then you do still own the relevant interest. So in principle, you don't relinquish the right to claim the SBAs. Now, obviously, if the lessee does anything to alter the building, where that falls within the general definition of qualifying expenditure, then they can claim structures and buildings allowance on that amount, because they incurred the costs at a time when they were actually owned a relevant interest in the property. But it's not just as straightforward as that, because there can be some cases where actually the right to claim the original SBAs, the structure and buildings allowance, does actually transfer across to the lessee. So in that situation, you have got to consider the particular provisions. What would then happen is that effectively the allowances would pass back when the lease ends. So the lessee then effectively gets the expenditure, gets the writing down allowance for the length of the lease, but then the entitlement passes back at the end of the lease. This only applies where there is substantially a sale. But effectively, the legislation tells us what that means. So if the lease is for a period of at least 35 years, and the market value of the retained interest, so the freehold reversionary interest to that lease, is less than 1/3 of any capital sum paid for the acquisition of the lease. If it's exactly 1/3, then the condition is not met. So let's have a look at an example of that. A owns the freehold of a property and grants a 30-year lease to someone else, charging a premium and annual rent. Because the lease is less than 35 years, A will continue to claim the allowances. They will not be able to, they will be able to set those allowances off against their rent, but the lessee does not get any of the structures and buildings allowance. S owns the freehold of a commercial property, grants an 80-year lease to M, charges a £300,000 premium and an annual rent. The retained interest of the reversionary interest is £75,000. The lease exceeds 35 years. The market value of the interest retained is less than 1/3 of the capital sum paid. So the allowances get transferred to the lessee. If no premium is charged, although it is quite rare to find on longer leases that you don't have premiums charged, if there is no premium charged, then clearly the market value is not going to be worth less than 1/3 of the capital sum paid, and therefore there are going to be no allowances that can be claimed. Now, just to go back to that previous slide, I talk about that on there, that the lessee alters the building, and if they alter the building, they could claim structures and buildings allowance in their own right. I suppose it's probably a good point there to just think about what expenditure actually qualifies for structures and buildings allowance. New builds, clearly, we've talked about that already. Extensions, alterations, refurbishments and renovations are all categories of expenditure that are retained within the SBA provisions. It is going to be, however, only expenditure which is capital in nature. So anything that is tax deductible, well, if it's tax deductible, you are going to want to deduct the tax anyway, aren't you? So I suppose refurbishments and renovations would mean those kind of projects where you are actually going to be doing some kind of fairly significant amount of work on the building. If it is capital, then you should be able to claim SBAs on it. Okay. Now, interaction with capital gains tax, and this is one thing which one area where I think again we do see some confusion arising in relation to capital allowances, fixtures and so on. There is a different impact of fixtures and structures and buildings allowance. So when you are computing a capital gain, you do not make any adjustment for the value of the fixtures. So if you are allocating, if you're selling a property for £1 million and you decide that 100,000 of that relates to the fixtures, then you do make an adjustment. You don't make an adjustment. So the sale price is £1 million, and the same would be true of any acquisition cost. And that is, of course, because any value that you allocate to the fixtures will be adjusted for in the capital allowances computation. If you are talking about any structures and buildings allowance that has been claimed, then you have to adjust the gain for the amount that has been claimed. So you either add it to the gain or you deduct it from the base cost in calculating the gain. Now, of course, that is because, as I've already said, the difference between the fixtures provisions and the SBA provisions is that the SBAs are not going to be clawed back if you sell the property. So we do have to see an adjustment through the capital gains computation. So X Limited constructs an office for £2 million, excluding the land. They decide that a significant £500,000 of that relates to the fixtures. Structures and buildings allowance is claimed on the balance of £1.5 million. So you would not claim, and I should have mentioned this earlier on, you would not claim SBAs on any figure within the computation that related to fixtures. So after 7 years, the office is sold to a business for £3 million. And for reasons which are never particularly specified, agrees to allocate only £1 to the fixtures so that X Limited does not get a balancing charge on the sale. So effectively what we're saying is that X Limited has expensed all of their integral features. They claimed annual investment allowance on all of it. So their residual value carrying forward is zero. So they put £1 onto it. So that statement that they will get no balancing charge is not strictly correct, because they will get a £1 balancing charge. And you have to put a value. You cannot transfer assets for zero, because if you transfer assets for zero, the legislation imposes the market value. So you have to put at least £1 for capital allowances purposes. So they would get a balancing charge of £1, but no more. On the face of it, the gain appears to be £1 million because the value of the fixtures is not adjusted in either the sale price or the cost. But actually the SBA claimed has to be added back to the gain. That would be £45,000 for 7 years. So the actual total gain is £1.35 million. Okay, sorry, let's go back to the previous example, because I've been asked a question on this. So the question that has been asked is, in the first example, can T, who is the lessee, claim any SBAs on later expenditure, even though they do not hold the relevant interest? Or can they not claim their own expenditure as they don't have a lease longer than 35 years? They do have a relevant interest. The relevant interest, just because the lease is less than 35 years does not mean to say it is not a relevant interest. It is treated as a relevant interest. So if they incurred capital expenditure, which fell within that definition, refurbishment, renovation, and so on, they would be able to claim SBAs on that additional expenditure. So it's only talking about the SBAs which were originally being claimed by A that don't get transferred. But yes, they would be able to claim an amount on anything else that they incur. So hopefully that has clarified that point. I think this issue with the capital gains is one that people do miss sometimes. And so, again, I think it's worth basically that they can do that. Let me just answer a couple of questions, and then I'll just do 5 minutes starting on the next section, and then we will have another break. So the first question actually goes right back to the ATED point that we were talking about at the beginning. Company owns a freehold, the sole shareholder owns a lease on one of the flats. The reversionary interest is held by the company, is worth £3 million. the sole shareholder has owned a long lease on one of the flats before he bought the company, and that flat value is valued at £2 million. So the leasehold value of the flat is going to be £2 million. The individual is not going to have an ATED charge. I think if the reversionary interest held by the company, if all of them are long leases, I don't think that the reversionary interest counts as a residential property interest for the purposes of ATED. So I don't think that you would have a problem, because I think the get out of jail free card that you have there is that it is not a dwelling if they are all held on long leases. So again, I think that is the I think that's the definition. I'm just trying to look. I've got a feeling that is going to be the chargeable interest. And I can't particularly see that exemption. I will check that if I can in the coffee break, but I think that is the case. Where you have someone who owns a residential property who has incurred capital expenditure on fixed plant and integral features, if they then change the use to furnished holiday let, can they subsequently claim capital allowances that previously would have had no claim against them? They can, because what happens is that the furnished holiday let legislation treats you as acquiring any assets on which capital allowances can be claimed at the market value at the time that the furnished holiday let business commenced. So you'd have to work out what the market value was of those assets. They wouldn't just automatically get what the original cost was or an apportioned part of the original cost. You bring them into your furnished holiday let business at the market value at the date that that business commences. Question that's been asked: if you don't adjust the sale price of the fixtures, aren't you paying tax twice on that value? So a sale for a total of £1 million, including 100,000 for fixtures, would create a balancing charge of, say, 100,000, as well as including that amount in the CGT computation. Well, I suppose the point is that if you haven't adjusted the purchase price for the fixtures, you are, it would be a new, if you had acquired that property with £100,000 worth of fixtures in it, it would then be neutral from the perspective of the capital allowances pool. And then the acquisition and the disposal would also have the 100,000 in it, so it would be neutral. So actually, because you have got the value of the fixtures when the property is acquired, you have then effectively got, you're only paying tax on the uplift in value. I see what you mean, but ultimately that's what the legislation tells us. The legislation tells us that we have got to, we don't exclude the value of fixtures. So I think it does. I mean, I've thought this through before, and I think that is the answer. Right, leases. I'm only really just going to introduce this section, and then I think we will have a coffee break. So why are we talking about leases? Well, of course, the point is that when we need to consider the tax implications of commercial property, there are an awful lot more situations where commercial property will result in a lease being granted. So we need to consider what the tax position is for the person granting the lease. We need to think about what happens when leases are assigned, because again, we get transfer of leases. And I suppose one area where we do also have to consider the tax implications are going to be when tenants are wanting to get out of onerous leases. So they have a lease on a property that they no longer want. And so we need to think about the tax implications of doing that. So actually, when we're talking about commercial property, and I think that this is an area where we don't necessarily get a lot of talk about this on normal property updates, is we need to think about what the different tax implications are of all of those transactions. Right, well, I make it 2 minutes to 11, so I think that we will now have a break again. And I think if we come back about 5 past, that will have given us about 15-minute break across the 3 hours, which is what we would normally be looking at. So again, if you have any questions as we go through, then please feel free to pop them in the chat box. Okay. Right, I've been having a look during the coffee break at this ATED question, and I can't find the answer. It's not the answer I thought it was. So again, the chap who's asked the question, if you want to just drop me your email address, and I will see if I can find the answer and email you the answer. Yeah, okay. So leases. So the first one that, the first situation we want to think about is if you grant a lease for market rent, then there are no capital implications. The income is just taxed as it arises for the landlord and will be deducted by the tenant if they are occupying it for the purposes of their business. If they were subletting it, they would be able to get that deductible as well. So for anyone who is a business, then they are going to get a tax deduction on that. So that's fairly straightforward. If a premium is paid, then you have to consider the capital gains tax issues. It is going to be, and sorry, I'm just writing down this email address before it disappears. Basically, there are potential capital gains implications if there is a premium paid. It's a part disposal, and when we have part disposals, if we go back to the basics of capital gains tax, we will know that we allocate the costs on an A over A plus B basis, where A is the amount of the premium and B is the reversionary interest, so the value of the interest that the individual continues to hold. Now, if the premium is, and so if you granted someone a 999-year lease, or no, actually it's just a 125-year lease, you look at the premium that was being paid, and then you would calculate any capital gain using that formula, using the base cost of the company, of the property, using that formula, and then you would just have the capital gain. The complication comes where the premium is for a lease of less than 50 years, because there is an apportionment of the premium between revenue and capital for both the landlord and the tenant. And so we have to calculate the amount of the premium that is taxable. And we use a formula which is basically we take the length of the lease minus 1 year, and we take 2% multiplied by the length of the lease minus 1 year, and multiply it by the premium to find out the capital element of the transaction. And we'll have a look at a calculation in a minute. If you were then calculating the capital gain, you would use the capital part of the premium in calculating the apportionment under the part disposal provisions. Now, one of the problems that we do have with formal leases is where you have transactions between connected parties. So if you have a formal lease, if you grant a formal lease to, let's just say I own a property and I grant a formal lease on that property to a company which I own, that will be a connected party transaction. And if I don't charge market rent, then market value will be imputed onto that transaction. And the issue is that we don't actually increase the rent. What we do is we impute a premium, which, as I say, is then taxed on a part disposal basis. But those rules can only apply if you have a formal lease. So if you do have a formal lease put in place, and we have talked a couple of times already about the fact that there might be advantages in having a formal lease in place, you do need to be careful in terms of the term of that lease so that you don't get potentially a capital gain arising. Okay. Right, so let's just say you've got a 20-year lease on which the lessee pays a £50,000 premium. The premium is 50,000. The capital element of that is 19 times 2% times 50,000. So the 19 is the length of the lease less 1 year. The 2% is the figure that is set in the accounts, and the 50,000 is the premium. So the capital element of that is 19,000, which means that there is an amount taxed as income, 31,000, and then the capital element will be 19,000, as we say. The shorter the lease is, the more of the premium is taxed as income. Yeah, that's logical. I always forget the way round it is. But yes, that needs to be taken into account. Okay, so that calculation of the gain and so on, I think is something that is fairly well understood, perhaps not by clients, but hopefully most accountants will be reasonably happy that they understand the way that that is going to work. What about a situation where an inducement is paid to the tenant to encourage them to take up a tenancy? I'm sure that we have all heard of anchor tenants in shopping centres. So the perception is always that if you get a good quality anchor tenant, you know, someone like John Lewis, possibly, you know, Selfridges or Harvey Nicks in some places, though there's not many of those, but John Lewis or perhaps Marks and Spencer's is a good anchor tenant, encourages other people to come into a shopping centre, a mall or something like that. But there will be lots of other circumstances where someone has got a property and they offer an incentive to get the tenant to come in. These incentives are often called reverse premiums because rather than the tenant paying the landlord is paying the tenant. Now, if you make a payment in cash as a reverse premium, the tenant will be taxed on that as income because there is specific legislation which says that they will be taxed on that as income. Now, there are often it will be a receipt of trading business or property business, depending on whatever it is they're going to use the property for. The landlord is not typically going to get a deduction for the payment of that reverse premium because it will be a capital enhancement cost. So if you have a property and you pay a premium for somebody to occupy it, that is going to be enhancement expenditure for capital gains purposes because your property is likely to be more valuable if you have got a sitting tenant. If you're a property developer giving someone an incentive to become a tenant in your property, then you might get a deduction in computing the profits. Then again, it is going to be a potential problem. However, when we look at the definition of what constitutes a reverse premium, it's not just a direct cash payment that is caught. The legislation says that it will catch a contribution to fitting out costs, assumption of liabilities. So if, for example, your tenant is already paying rent and you say, well, come into this property and I'll pay the remaining rent, or I'll pay the amount that you have to pay to get out of your lease, or paying of any other sums to third parties. So if, you know, if there was anything that you had to pay to a third party, whether or not it related to another property, it would still be taxable as well. So again, you have to be a little bit careful in those kind of situations. What is not caught as a reverse premium is a rent-free period. Though, of course, having a rent-free period is not really necessarily efficient, because, of course, the tenant does not get, but doesn't have to pay the rent, I suppose, but they also don't get a deduction for it. Though, if there's a rent-free period, I think under accounting principles, you actually have to spread the rent over the whole of the lease, so you would get a deduction even where there's a rent-free period. So often you will see that the most attractive proposition is that you offer a rent-free period. So we do see that quite often in situations where people are wanting to pay incentives. Okay, assignment of a lease is just a sale. You know, effectively is just going to be where the lease is being sold to someone else, and it is no less of a disposal than disposal of a freehold is. Assignment would normally cover a situation where you actually sell the lease to someone else. Obviously, if you sublease, then it's just the grant of a lease, and there are complications on granting of leases, but we're not going to talk about those today. Again, if it's a long lease, it's just calculated in the normal way, disposal value less cost. The complication comes, if it's a market rent lease and there's no premium, then there would be no gain because you've got no capital cost. And that would still apply even if it was a market, if it was a connected party transfer. If it's a short lease, so a lease of 50 years or less, then you would still have a capital disposal, but you have to waste the original cost. So any premium that you have paid basically reduces over time. In Schedule 8 of TCGA 1992, there is a wasting table because property does not waste on a linear basis. It's quite slow to start off with and then it accelerates. So depending on the length of the lease, there is a formula as to how you can work out what the allowable expenditure is. Just while we're still talking about leases here, question has been raised. I was talking before about imputing a premium for an undervalued lease between connected parties where full market rent is not being paid. And somebody has asked whether that could also apply where you have got residential property being transferred on a buy-to-let. And the answer to that question is yes. So if you grant a lease to a company that you are own and they then rent the property out on a buy-to-let basis, and you are not charging the market rent, then there is a possibility that a premium could be imputed. And I have a case working with the revenue at the moment on that particular point. So it is quite important to understand those provisions. Okay, right. Surrender of a lease. Now, surrender is where we have the lease being sort of disposed of to the immediate superior interest. Now, that will often be where a lessee surrenders the interest to the freeholder. But if you had chronology of leases and subleases, then it would be any surrender to the person immediately above you. So it is a disposal by the tenant and an acquisition by the landlord. Now, I should point out at this stage that the lease simply coming to an end is not a point at which there is any tax liability. So this is where you have a situation where either the landlord or the tenant makes a decision that they would actually quite like the lease to end. So the landlord might want to get rid of the tenant because they want to sell the property. The tenant, it might be onerous. They might want to downsize. You don't know why. But this is where we have a transaction which involves a termination effectively of the lease before its final point. So to a certain extent, because it is just a disposal and an acquisition, notwithstanding that the lease will disappear at the point at which it is transferred back to the reversionary interest holder, it's the same basic provisions as for other persons, but there are tweaks. So if a sum is paid by the landlord to the tenant, that will be a capital receipt for the tenant, wasting of any expenditure that they incurred to find the capital gain. But if you have a situation where a tenant is paying market rent so that there was no upfront premium, then the whole of any capital sum that they receive would be subject to capital gains tax. The landlord may well be able to add that cost to his base cost for capital gains purposes as enhancement expenditure, but that is only ever going to be allowable if that enhancement expenditure is reflected in the nature of the asset at the time of sale. So if somebody pays their tenant to get out of the property and then they sell that property immediately, notwithstanding what I said about properties being more valuable with a sitting tenant, not necessarily the case in some circumstances, then they would get that amount as a deduction against their capital gain on the sale of the property. But if they're getting rid of their tenant so they can get a better tenant in, as soon as they have that property tenanted again, then that enhancement expenditure becomes void because it is never reflected in the nature of the asset at the date of sale. So again, where you have a payment from the landlord to the tenant, in the same way that you have with reverse premiums, you can get a situation where there is a tax charge on one but no immediate tax relief on the other. And indeed, that is what happens if you have a payment made by the tenant. It is a capital payment, but it's not a capital payment which is ever going to be allowable, because somebody making a capital payment where there is no underlying asset, and let's not forget that the asset disappears as they make the payment, so they are never going to get any capital tax relief. It does not create a capital loss. It is simply a capital payment which is not allowable, but it then would be taxable on the landlord as a capital sum. Now, if the lease provides for the payment to be made, it's not a part disposal. If the lease does not provide for a payment to be made, then it's a part disposal, and you would do the A over A plus B computation to get the base cost. So if there's no provision for such a payment, which is actually quite rare, i.e. that is not the case, then it would not be a part disposal. What if the landlord chooses not to merge the lease into its freehold after a surrender? This is not automatic. Well, you say it's not automatic. But my understanding is that from a landlord perspective, there are problems about holding the leasehold and the freehold interest separately in the same name. I do know that there are ways of getting round this, but actually, I don't think it matters whether you get merging of the freehold and the leasehold afterwards, because it's still basically an acquisition of the lease by the landlord. So, you know, because sometimes what you get is that, you know, another part of the group of companies that of which the landlord is a part will acquire it. I don't think it matters. It's still going to be treated as in exactly the same way. So if you don't merge the lease into the freehold, then it's not going to be enhancement expenditure for the landlord because the two have not been merged. I think that would be the only point, but I think you would get the same tax treatment for the tenant. So what do people do to get round this? Because obviously having any situation where you have got one party getting taxed on something where the other party doesn't get tax relief, there is likely to be some degree of unhappiness about this. What sometimes happens is that people try and structure the payment from the tenant to the landlord as being a payment for dilapidations. So most leases on commercial properties will be on what is called a full repairing basis, which means that the tenant has an obligation to return the property back to the landlord in the state at which they received it, on the basis that they have undertaken the repairs. Now, if they don't do that, and sorry, what I should say is, of course, that in that situation, most of the expenditure incurred by the tenant, you would expect to be revenue in nature. So we've already talked about that in the first hour. You would expect expenditure to be revenue in nature, but so the tenant would get a deduction for it. So the argument goes is that if they make a payment to the landlord in lieu of undertaking those costs, it's also revenue expenditure, so it would be deductible. So you structure it as a payment to the landlord in lieu of the dilapidations. The landlord would still be taxed on that, but then obviously if they do the work on the property, then they would get a deduction for the cost of the actual work, and therefore it would be neutral. Obviously, it is something that the revenue are very aware of that people try and do, and therefore you have to be quite careful when you are structuring these. You can't just have a payment be made and just say to the revenue, oh, well, yeah, there was no paperwork, but this was payment for in lieu of dilapidations, because the revenue are very unlikely to accept that. Now, let's talk about stamp taxes. Now, I'm going to talk about stamp duty land tax, which applies obviously in England and Northern Ireland. Land and buildings transaction tax is in Scotland. Land transaction tax is in Wales. Now, most of the basic provisions apply for LBTT or LTT purposes as they do for SDLT purposes. There are some differences, but what I wanted to do was just explain the basic principles. And these basic principles are pretty similar, even though there are some tweaks. So from an SDLT perspective, when you are granted a lease, there are two potential liabilities. You have to calculate what is called the net present value of the lease. And then you also potentially have SDLT on the premium. Now, the net present value is a basic capitalisation exercise on the rent with a cumulative discount at a rate of 3%. And you pay 1% SDLT in excess of the nil rate band of 150,000 and 2% above 2 million. If you are paying variable rent, sometimes on commercial properties, you will have what are called turnover rents. Basically, you estimate how much rent you think you're going to pay, and then you make a single revision either when the lease ends or at the 5-year point, whichever is earlier. Premiums you pay at what are called the ad valorem rates, with rent. There is a little bit of a trip up that you can potentially come across. And that is that an agreement to lease is also a document that attracts stamp duty land tax. So you do need to be a little bit careful about that. Premiums are subject to the normal rates that would apply if you were buying a property, freehold of a property, which means that it is nil up to 150,000, 2% up to 250, and 5% above that. Reverse premiums do not attract SDLT. And again, in exactly the same way as we have with capital gains purposes, if you have a lease being granted to a connected company, it's only a connected company. It would be all connected parties for CG purposes, but it's an adjustment made via the premium again. That's what I was trying to say. So again, you would impute a premium, you would have to pay SDLT on that. An agreement to lease is only taxable if the tenant takes occupation or pays rent under the effective date for substantial completion. Yes, that is absolutely right. Well, SDLT is only payable under a lease when there is payment of rent or where there is occupation before the payment of rent. And equally, an agreement to lease would only be taxable if the tenant actually takes occupation, or indeed if there is rent payable such that there is substantial performance. Yes, sorry, I should have clarified that point. Thank you for pointing that out. Where you have an assignment of a lease, that is, as we've said already, just going to be a sale, and any SDLT would be payable as usual. An expiry of a lease, as it has no capital gains implications, also has no SDLT implications. A payment by a landlord to bring a lease to an end would attract stamp taxes because, as we have said, they are effectively buying the leasehold interest. A payment made by a tenant to bring a period to an end would not attract stamp taxes because basically the lease and the payment are going in the same direction. Is there a minimum lease period for SDLT to apply? No, but from a compliance perspective, there is no notifiable transaction if there is no SDLT to pay and the lease is less than 7 years long. So if you had a lease of less than 7 years, you would not have to make a stamp duty return if there was no SDLT to pay. Now, there are other complications from an SDLT perspective because there are circumstances where, for example, you have indefinite leases where there are particular complications which are beyond the scope of this course, because I do actually do a whole 3-hour lecture on SDLT on leases. Not the most interesting course that I do, but no, so there is no minimum lease period for SDLT to apply, but I suppose you'd have to have quite a lot of rent to get over £150,000 when you look at the net present value. And if it's below the nil rate band and the lease is less than 7 years, then you don't have to make a return. Okay, so let's just have a look at the differences for LBTT and LTT. For land and buildings transaction tax, same rate of tax on the rent and on premiums, except there is no nil rate band if the rent is more than £1,000 per annum. which means that you effectively pay, gosh, I couldn't remember what the rate is then. 2%, isn't it, over 150 up to 250. So you would effectively pay 2% on the premium from 0 up to 250 and then 5% above. The compliance in Scotland is also slightly different because you register the lease and pay the SDLT, the LBTT at the same time. With Wales, the nil rate band is £225,000, and then you pay 1% up to 2 million and 2% above that. Premiums are slightly different. And again, you have no nil rate band in Wales, but only if the rent is more than £13,500 per annum. So same basic principles in terms of calculating, but just the figures are slightly different. Okay, so capital taxes. Now, if you wouldn't mind, the next poll, please. The next section I'm going to talk about is capital gains for non-residents. So what I would like you to do is answer the question, what is the date when non-residents became liable to capital gains tax on commercial property? So 6th of April 2015, 6th of April 2019, or do you believe that they are not liable to capital gains tax on commercial property? I might have given that last one away. As we do come into the last half hour of the webinar this morning, please do feel free to pop any questions into the chat, into the Q&A box, if it would be useful for me to answer anything. I think I've managed to get through the questions quite well so far, apart from the two that I haven't been able to answer. Okay. I think we can probably close that poll down now, if you wouldn't mind. Thank you very much. So, just over 50% say the 6th of April 2019. A few are saying April 15, a few are saying not liable on commercial property. Well, the answer to the question is that it's actually 2019. But of course, for a long time, there was little exposure to capital gains for non-residents unless they were actually trading in the UK. So whilst we learned right at the beginning that non-resident landlords are subject to income tax or now corporation tax in the UK, there was very little exposure to CGT. Now in 2015, the 6th of April 2015, we saw capital gains being introduced for residential property held by non-residents. And then in 2019, it applies to commercial property as well. Now, as well as bringing in direct holdings of commercial property, we also have a provision which now brings within the scope two capital gains, both residential, but more importantly, commercial property held through offshore holdings. So if you have an offshore company, you cannot avoid capital gains tax by holding the property through in that company and selling the shares. That will now be caught. So let's have, in a little bit more detail, let's have a look at these provisions. I'm not going to talk about this in a huge amount of detail, but I will just pop through these. So came into scope from the 6th of April 2019. The gain can, if you want, be calculated by rebasing to April 2019. You can have the whole gain or the whole loss arising instead. With residential property that came in 2015, you could also time apportion the gain before and after 2015. But just to point out, you can't do that with commercial property. You have either the whole gain coming in or you rebase to April 2019. As I said, we also have indirect disposals of UK property where the conditions are met, and that also applies to commercial property. It has to be a property-rich company, and you have to have a significant holding, and I will just touch on those in a moment. So if you have mixed-use property, then you split the gain between the commercial and the residential, and you rebase to different points. If there is a change of use, so if between 2015 and 2019, you converted a residential property into a commercial, what you do is you do 2 lots of rebasing, and then you apportion the gain that arises between those dates, although it doesn't actually crystallise until the date of disposal. I'll have a look at an example in a minute, but just go back to that first one where you've got mixed use. So if you had a shop with a flat over it held by a non-resident individual, you'd value the flat at 6th of April 2015, and that would be the rebasing point for that. You'd value the shop at the 6th of April 2019, and then when the property was sold, you'd combine those 2 acquisition cost, rebase costs in calculating the gain. But let's have a look at an example of this question where you have dual rebasing because you had change of use. This is someone who acquires a residential property on the 6th of April 2013 for £100,000. It's worth £150,000 at the 5th of April 2015. It's converted to commercial use on the 5th of April 18. It's worth £175,000 on April 2019, and then it's subsequently sold for £250,000. And of course, this calculation is made very easy because everything happens on the 5th or the 6th of April. So we have a rebasing to April 2015. There is a notional gain at that stage, but it's not chargeable. We then rebase to 2019, which then gives us an apparent gain of 25%. So, sorry, £250,000 to £25,000. I do apologise. It's been a residential property for 3 out of the 4 years between 2015 and 2019. Which means that 75% of that 25,000 gain will be taxed when this property is disposed of. So it's then sold for 250,000. We deduct the 2019 value, meaning that we have a gain of 75,000 just since April 2019. But then in addition to that, we add in 75% of the 25,000, which gives us a total gain of 93,750. I've not actually yet had one of those cases in anger. I've never had one where I've had to calculate it in reality. I have only ever had cases where I've done examples like this. So for indirect disposals of UK property, you have got the shares being chargeable where at least 75% of the value is derived from UK property. Doesn't matter if that's residential or commercial. You're looking at the gross value, so you do not deduct the liabilities, and you use the current market value of the assets to determine whether or not 75% of the value is derived from UK property. In reality, most property companies that I come across are just UK property, but there will be big multinational companies that have got value in that. We don't look at non-UK land, we are only looking at UK land. There are also other provisions, so there are provisions to do with related party liabilities. You can track the value through a number of different entities. But I am going to run out of time this morning, so I'm not going to be able to talk about that in more detail. You are only taxable as the individual holding shares or the person holding shares in that company if you have at least a 25% holding in the entity during the period of ownership, or 2-year period if that is shorter. So you only go backwards 2 years. Unless you have had more than 25% for what represents an insignificant proportion of the time. And that in HMRC's view is less than 10% of the time. So that is, I suppose, to allow somebody to have the subscriber shares in the company, for example, and then issue shares to other people. And, you know, they may have had 100% of the company for a very short period of time. You are looking in terms of ownership at voting power, rights to income, rights to assets. And in some circumstances, you also have to attribute the rights of associates, but you do not have to attribute the rights of siblings. So if you had a company owned by your mum and dad and you and your brother, you would be attributing the rights of your mum and dad, but not your brother. And so, you know, again, you have to just take that into account. So, you know, the capital gains provisions, of course, we mustn't forget that if you are disposing of any asset that is caught by these provisions as a non-resident, you have to submit a non-resident capital gains tax return within 60 days of the transaction. And so you don't just put it on your tax return, you also have a preliminary liability as well that you need to account for. And actually that non-resident capital gains return, I should just point out before I move on, it has to be made whether or not there is any tax to pay, because for the UK resident CGT return, you don't have to make a return if there's no tax to pay, but for non-residents, you do have to, even if there's no tax to pay. A couple of other things to think about with commercial property, which probably don't come up very often for non-commercial property. Rollover relief available when we have somebody who is trading, sells one property and buys a new one, both of them being used for the purposes of the trade. It can also apply where you have, say, an individual who holds property and uses it for the purposes of their trading company, or indeed for the purposes of their partnership. You just have to be a little bit careful, because to roll over the gain, it's got to be the same person holding the property for the same business. So if you had two standalone trading companies, you couldn't sell a property used by one and roll over the gain into a property used by the other. Reinvestment has got to take place in a period commencing 12 months before you sell the original property and up to 3 years afterwards. That time limit can be extended, but it's up to the discretion of HMRC. They're reasonably relaxed about that point, but you know, you don't know, do you? Got to be a qualifying asset, but that very definitely includes commercial property and also any fixed plant machinery. And if you are intending to reinvest, then you can defer the tax pending the reinvestment, though of course don't forget that there will be additional surcharges if you don't end up making the reinvestment. And we have partial rollover relief if not all of the proceeds are reinvested. Just have a look at a couple of quick examples. Somebody sells a freehold property which they purchased in 1980. They disposed of it for 254,000, making a gain after deduction of costs of 199,000. They buy a new property for 300,000 because they have reinvested all of the proceeds. Then the whole of the gain can be rolled over. They will have no capital gain to pay, and the base cost going forward of the new property will be £101,000. Part reinvestment, property sold for £300,000 makes a gain of £220,000. He buys a slightly cheaper property. And the basic rule of thumb in these cases is that the amount of gain that comes into charge is the amount that's not reinvested. So in this case, there is going to be a gain of 30,000 comes into charge, which means that we have rollover relief available of £190,000, and there is a base cost of the new property of £80,000. Are there special considerations for rollover relief when there is a compulsory purchase order property held in a company? No, for compulsory purchase orders, pretty much you are talking about the same issue, in that you will have the disposal proceeds, and if you reinvest all of them, then you will get rollover relief. So there's not material differences between the two. Good question. How amenable do people find HMRC regarding time limits? We have a client who's bought land when it became available, but it's taken a while to get planning. They can't, of course, move trading facilities from the existing site until the new one is built. So the sale will take place more than 12 months from the date of the original land acquisition. Wondering if they could roll into the original land acquisition. To be honest with you, I have found the revenue always pretty amenable in these situations. The longest period of time that I have ever managed to get the revenue to agree, well, actually, no, I didn't do the work. I can't take the credit for it, but I'm aware of the case, was 25 years. But that was where somebody actually sold farmland to the Department of Transport to build part of the M62, I think it was, a motorway anyway. And then they were then in dispute with the Department of Transport for 20 years or 23 years as to how much compensation they were going to get for this land. And so they didn't have the money, and as soon as they had the money, they reinvested it in farmland, and the revenue allowed them to claim rollover relief. Mind you, I think the inspector I was dealing with or was being dealt with, I came in very much towards the end of it, was just very embarrassed at what was going on, really. So that is obviously an extreme example. But yes, I think that there would be a pretty good argument to be made there. And I certainly think it would be worth, approaching the revenue for that. So yes, I would certainly have a go at that. Business asset disposal relief is going to be relevant to sales of commercial property. Either way, you are selling them as part of a sole trade or a partnership. Not really going to get them if it's just sale of the property. If you can't get business asset disposal relief, then you probably would be looking at rollover relief. Associated disposals, where you're holding property outside of a partnership or a company, you have to be a little bit more careful with. I'm very aware of the fact I'm glossing over this very quickly, but I know that I've covered, a lot of people cover business asset disposal relief because it is in the context of very many different types of situations. So hopefully you are going to have knowledge of that from other sources. If we look at stamp taxes, most of the issues with SDLT and all of the other stamp taxes actually relate more closely to residential property. Whether or not something is residential property becomes very relevant, because then the 3% supplement becomes payable. The 2% supplement for non-residents is going to be relevant as well. Stamp taxes are typically payable on commercial property, but as a reduced rate as compared to residential property being a dwelling house plus the land that forms part of the garden or grounds. Anything else, including anything that is mixed use, is non-residential. The kind of issues that we have problems with are going to be commercial property where there is a residential component, and the most obvious one is with farms. In reality, you are not going to see a problem where you are buying a residential property with land associated with it where there is current commercial usage. We've had a number of tax cases over the last couple of years where people have tried to argue where they are buying residential property that has got a significant land component in the sale, that land makes the transaction mixed, such that you pay on non-residential rates. And the courts have universally agreed that if there is no non-commercial use of the land, then it is residential. And I suppose the biggest problem that I see is where perhaps you've got someone who is buying a farm, a property with land associated with it, where perhaps the previous farming activities have lapsed because perhaps the previous farmer had become unwell or something similar, and you know, there is no current commercial usage. If there has been relatively recent commercial usage, then you should be okay. But if there is not, then there may well be problems. Now, that I was intending to talk about that, but I have less than 5 minutes left. So I suppose it's about thinking about what is the best thing to talk about. Reverse charge for construction services for VAT purposes. I won't go through that. There are details on your notes, on your slides, as to how you deal with that, and what you put in the various VAT boxes and what end users use. There is a slide there which summarises what VAT is payable on different types of properties. And I suppose probably the most useful thing to just go through, though it is very, very quick, is that with commercial property, if we go back to this table, if you have got commercial property, then it is, if the disposal or the transaction is within 3 years of completion, it is automatically standard rated. But beyond that, the supplier can opt to tax. Option to tax is a two-stage process. The first is where the owner takes a conscious decision to opt to tax the property, and then where you notify the revenue of that fact. Strictly, you have to notify them within 30 days, but HMRC does accept late notification. If there is a clerical error in charging VAT on the property, then no option has been made, and it is likely that no retrospective permission will be given. If the director deliberately decides to charge tax, but did not notify, so that there was a conscious decision to opt to tax, but didn't get round to notifying, then potentially it can be backdated, but it is not straightforward. There are some situations where it's kind of automatic, but there are situations where HMRC are required to grant permission if you have made an exempt supply of the land or buildings within the last 10 years. But there are various circumstances where an opt to tax is automatically going to be met. There are 4 conditions that are set out in the law. The conditions are fairly long-winded, but if you look at Notice 742A, they are there. It's designed to counter tax avoidance arrangements effectively. Opt to tax is made on a building by building basis. It is unique to the person making the option. It doesn't bind any subsequent owners or users of the land. There are rules about what comprises a single building. So connected buildings can be a single building. And it also does cover buildings within the curtilage. There is always disputes about the extent to which opt to tax operates. What sort of situations you can apply. And so it is not always a straightforward area. Right, a couple of questions. Somebody's asked, conversion of a public house with flats above into 7 flats. What VAT rate is applicable on the conversion? Conversion on non-residential to dwellings is normally 5%. That would normally, I think, give you that answer. Somebody did ask about the slides. Again, they have been popped into the chat box, and hopefully they have been put in again. And I think actually they have been sent directly to the person who asked. And again, there are a couple of people who've said that they can't seem to get a copy of them. Hopefully, I mean, the administrators of this course have got copies of the slides, so I'm sure if you have not managed to pick them up, they have just loaded them back into the chat box again. But I'm sure if you don't manage to download them from the chat box, if you email them, they will be able to send them to you. Hopefully that has been picked up. Right, well, that gets us to the end of this morning. Thank you very much for your time. It's Friday. So it's slides, actually, there are no notes there. The slides are just have just been sent. Have a lovely weekend, and hopefully I'll see you again soon. So thank you and goodbye.